So I guess we'll just get started. We have three bankers, two valuation experts, and a lawyer. We're heading to cocktails at the bar, so this sounds like the beginning of a joke. But I guess what we're really here to talk about is valuation and pipes, how they are interrelated, and hopefully also provide a bit of a historical perspective so we can see, what we might have learned from the bubble era where things went sideways in that market. So before we get started, maybe we can just go down the line. Everybody introduce themselves, please. Tell us how you fit into the ecosystem.
Hi, everyone. My name is Gaurav Verma, and I co-head the banking efforts at DeBorral Capital. We're a very active underwriter on the SPAC IPO front, along with the de-SPAC process of Target, introducing our sponsors to Target, de-SPAC pipes, and raising capital post the business combination close.
Hi, I'm Giovanni Caruso. I'm co-chair of SPACs at Loeb & Loeb. We represent all targets and sponsors in various stages of the SPAC transaction.
Joe Tonis, Roth Capital Partners. I lead our SPAC investment banking efforts and also our principal SPACs that we've done as firm-sponsored SPACs ourselves. Been in SPACs for 10 years. I've been a 7-time SPAC sponsor. Work with sponsors throughout the entire SPAC transaction. As Gaurav kind of mentioned, same thing for us.
John Aglotti, Marshall & Stevens. I work in transaction advisory services. We primarily do fairness opinions and solvency opinions, but in the SPAC world, obviously, our primary role is providing fairness opinions. We do that on both the buy side and the target side, but I would say 95% of our work is on the buy side, but it's just the way it kind of turns out. We don't market it that way.
Jonathan Grubbs. I'm a director and leader of the complex financial instruments practice at Aprio Advisory Group. Aprio is a full-service audit, tax, and advisory firm, and we look to help both sponsors and targets prepare for successful de-SPAC transactions.
Great, and I'm Mark Van Trick, head of capital markets for Early Bird. Might have seen in the SPAC trivia that we came up with this structure some number of years ago. Also involved in the full spectrum of services around successful raises for sponsors and ultimately de-SPAC transactions that hopefully trade well. So I think it's a logical starting point to start with valuation because I think we heard the statistic that 15% of SPACs are trading above $10, leaves a lot that didn't. I think reason number 1, 2, 3, and 4 is probably valuation. So I'd be curious to hear from everyone on sort of what you feel has changed about the approach to valuation, particularly from the target side. Is there some more realistic expectation? How do you ensure that you bring a deal to market that isn't just a product of SPAC sponsors sort of bidding the asset up in a SPAC off, but rather that you find a deal that's compelling for the investor? Just throw it out as a jump ball.
Well, so I can start. From the attorney's perspective, it's a really hard thing to stop that from happening, right? You try to advise your clients that it's not always the best thing to get the highest price for the transaction because you have to think about what the stock price is going to do after the closing of the de-SPAC. But it's very hard for targets who have a certain number in mind to be told that really a lesser number is more important and you're going to have more benefit longer term if you take a lower valuation but your stock trades well afterwards.
Yeah, and just to add to that, I mean, with the the rule changes of not putting projections in the S4 or F4s, you're kind of relying on your historical numbers to a large extent and using comps or precedent transaction multiples and valuing it based on your last year's revenue or EBITDA. I think that's a fair way to value a lot of these companies. So we don't have those hockey stick projections anymore, hopefully. where generated zero revenue and you'll be $1 billion next year. Hopefully that has helped a lot of the valuation to be a little bit more in check. Having said that, you always get pushback from targets that may have unrealistic expectations, but kind of just bring them back to what you would do in an IPO. You're not going to be able to build a book if it's overvalued. It should be the same way for a de-SPAC, because PIPE investors are not going to be interested if it's overvalued. They'll want a discount to market, and it should be the same methodology followed for a de-SPAC.
From our side, one rule we always have at Marshall & Stevens is we always say, we don't rubber stamp deals. So if we see a valuation that we think is way out of range, we want to know why, where that came from, and start digging it down. And I'll say, these days, the SPAC and the target are much more open to that discussion versus throwing their hands up and saying, well, that's the number we agreed upon, and they're much more open to it. And I think every time we've run into that, it's not all the time, but every time we've run into that, the deal's been repriced because everybody understands that, or it's been restructured with an earnout and the upfront consideration. So I think people are much more understanding of that now than they were in 2021. So.
Yeah, and just to follow up on that last point, John, I think that bridging the gap doesn't necessarily have to be taking off the headline purchase price. We've seen a lot of sponsors and targets renegotiating and restructuring these with larger earnouts, more difficult to achieve earnouts where value's there if projections are met, but if they're not, then you're leaving money on the table for the IPO investors to actually have some upside.
I think from my perspective, what's always interesting is it's helpful to try to explain to targets that this is not a crystallization of value, right? It's a mark to market. Ultimately, if you embrace going public, the market will decide what you're worth that nanosecond. And it's really important to try to reorient the conversation around the fact that ultimately, hopefully, you're raising a relatively small quantum of capital into a much larger business. So the dilution really applies to that. And really, the difference between a compelling valuation to the market and one that overshoots may be very few points in ownership to the target. And if you're doing a de-SPAC transaction for the right reason, i.e. you're going public because it is a catalyst for your business, the currency means something to you longer term, you're willing to embrace the responsibilities you have as a public company, and you're not looking at this as a discrete financing event where you say, okay, great, I raised 20 million bucks and I'm never going to be heard from again. I think that's really a good way to try to reorient people towards more realistic expectations, more pragmatic approaches to this process. And it's really a litmus test for target companies about whether they're really doing this for the right reasons, right? And ultimately, I think everyone here on the panel wants to see deals that are compelling, that have a thesis behind them, and that succeed. Just curious if your process in terms of doing these valuation analyses has changed since sort of the bubble. Are more sponsor teams, targets relying on third-party opinions to validate their valuations, et cetera?
I'm happy to start. I think there's just, along the lines of being more realistic, it's looking more so at public comps than before. I think before you saw a lot around DCF valuations and just the hockey stick growth curves and saying, hey, what's this company going to be in 5 years? Let's price it off that. The market's not willing to look at that, and I think finally both sponsors and targets have realized that coming out of 2021. And that's helped to reset things, because when you see, okay, here's the comps trade at 10 times EBITDA as an example, you need to be at or below that to get the market's attention. Probably below that. Regular way IPOs are not priced at the comps or above. They're priced at a discount. This is a variation of an IPO, so there's no reason it should be a premium to where those trade.
And I think the more reasonable projections now that we see makes it reconciling the DCF much easier with the comparables, because we were seeing valuations, you do it under a DCF, you're coming out at $1 billion, you're doing it under market comps, and you're even at the higher third quartile range, and you're at $500 million, something's off there. And that just shows you that there's way too much optimism in those projections, or the risk rate isn't high enough. So it's been much easier for us anyway, that triangulating all that in and not, like you're saying, not having, you never want to go above the multiple. So I don't know, it's just been a much easier process where you're not constantly going back and forth.
Yeah, and I think with more and larger pipes coming in behind these, as we've seen redemptions rise, just to guarantee some level of cash to the balance sheet, it gives you another view of valuation. And I think that pipe investors have become a lot more rationalized as market participants as well. They've taken another look at what does the cost of capital actually look like for this company? And so outside of just projections coming down, you're seeing more reasonable and more supportable valuations from other third parties, which gives you more comfort in, all right, well, if we can't support this from a projection standpoint, it might be haircutting those projections, it might be increasing cost of capital, or it might be just revisiting from the ground up.
Yeah, and we hated to see, and again with those optimistic projections, that if you had to get it to work, it was like we needed a 45% discount rate. Just that it's so speculative at that point that it's like this isn't making sense. So we've been able, and we do a lot more benchmarking now, and like you're saying, checking with the industry. Are they growing way in excess of the growth of the industry? Are their EBITDA margins way off? Or is their CapEx right? So we do a lot more benchmarking to get a lot more comfort now. We always did that, but we just dig a lot deeper now. So, and Matt Gray, if you heard him, he stole my thunder. I was going to say all that about the projections. Like we always say, you got to have a story, you got to have a build. It's got to make sense for us, for management, and then also when you're doing the S4 or F4 filing. So it shouldn't be a one paragraph on how you got your projections. It should be.
No, I think another one of the challenges for sponsors and banks in talking to targets is, people tend to overvalue their baby by definition. They want to be valued as the company they hope to be when they grow up, as opposed to the company that they are now, plus a discount, right? It's sort of on opposite ends of the bookend. And the process isn't instant coffee, right? You get the valuation by executing, as people said earlier, over-delivering, under-promising, doing that regularly. That's what sees your multiple expand, right? So you have to be willing to embrace that process. And again, it's a tough conversation to have with people. You had mentioned earnouts. I'm just curious to see, how they've changed versus before. What is a good structure? Is it financial metrics? Is it stock price? Is it a combination? How many, points of vesting should there be? What is the ultimate size versus the original valuation over what time frame?
That's a loaded question, Mark.
Well, yeah, that's why we're here. We're
How much
trying
time
to keep
do we have?
attention
Right.
before
Yeah.
the bar opens.
Who wants to start?
Yeah, I'd be happy to. I think that back in 2020, 2021, I think that what we were seeing was that these earnouts, while they existed, they were all identical across targets, right? And when you think about what an earnout is supposed to do, it's supposed to bridge the gap between buyers and sellers, the sponsors and the targets in terms of valuation. It doesn't make sense to have a one-size-fits-all approach to those. And so what makes the most sense? I know that it's awful to answer every question with "it depends," but structuring this, how many hurdles, whether they're financial or stock-based, who's receiving them, what makes the most sense, it really depends on where is the risk here, what is the upside, what is the downside, and how can we best bridge the gap? Because that's ultimately what these mechanisms are trying to do, right?
Yeah, in the early times, we love earnouts. We just think they're a great idea. It's a great structuring tool. But we were seeing earnouts based upon share price performance, which we just didn't like that. There's too many other factors going in around it. And we constantly would say, get the earnout tied to the projections they gave us, whether it's revenue, whether it's earnings, whether it's both, because then everybody's aligned. If you make your projections, the value's there. So it's up to you to make the projections. and to make the milestones. I mean, we generally see earnouts 2 to 3 years, I would say, if I had to rough it out. That's usually the way, but it's just a great structuring tool. I also like it because the seller is focusing on the max number because they're really optimistic, and the buyer's looking at the realistic number, which is fair valued. It's probability based. We do a Monte Carlo simulation on ours based upon revenue volatility or earnings volatility. We'll run it 100,000 rounds, and it'll give us basically the effective probability that those projections are going to get made. And that, if it's a 50% factor, it's applied to that maximum, or usually as, you know, because it may be 100, 100, 100 or something. So we apply it and discount it back, but that's how we do it.
I think it's a little dependent too on whether we're talking about a sponsor earnout versus target earnout, right? Target earnout's much more driven by things that are in their control, right? Company KPIs, you know, financial metrics, that sort of thing. For a sponsor who's deferring part of their promote, you know, share price triggers probably make a lot more sense because, you know, you're earning on the upside as investors are earning on the upside as well. So I think it depends on which side of the equation that you're looking at, but, you know, also trying to keep things in folks' control to some extent and not be driven exclusively by external factors.
Yeah. I think one of the things that John said was really important, right? Earnouts are a really good way to bridge the gap between what the target wants and what the market will bear, right? Because they, as you said, right, the target will see, well, if everything works out, I will get a much higher number. And I think it's very valuable from that perspective. It's one of the tools that we try to use to help negotiate deals when there's a disparity between the two parties.
The only thing, I mean, I agree with everything said. The only thing I'd add is, you know, the earnouts also depend on sector, right? If it's healthcare or pre-revenue businesses or something of that sort, harder to base it on revenue. So share price may be more, but others, you know, you could, if it's a revenue generating EBITDA multiple and comps have a certain, you know, benchmark, using that could be more relevant.
Well, it's turned out to be a hot button issue. I think from my perspective, I think investors probably much prefer share prices because ultimately hitting KPI, if the share price is at $4, like they're not going to feel a lot better about that. The other thing that I would keep in mind is you have to look at the annualized rate of return, right? If you have a $15 or $18 hurdle, that's great, but if it's over 5 years, you know, and you're single-digit return, I don't know if you need like extra compensation for that either, right? So there's definitely a lot of factors to consider, and again, opposing views in terms of whether you're the sponsor, the target, the investor. Yeah, I think ultimately it's really important to make something that's meaningful. In other words, if you achieve the earnout, you know, the investors have done well, and obviously the target will be doing well as well. So just shifting to pipes a little bit, curious to see what your take is, Joe Gaurav, in terms of the investors that are participating. Do they look different? Are they different names? Do they have different approaches? Are they looking for different things?
Yeah, I'm happy to start. I think a lot of the names we're seeing are the same names that we saw during pipes in 2021, but they're back with more realistic structures, valuations. Everything is not necessarily a momentum trade or a FOMO trade the way that we saw 5 years ago. Are there some new entrants? Sure. Are there some guys who have left? Sure. But I think largely the same suspects. I think very recently we've seen a lot less structure on pipes, and I think that's driven by realistic valuations, you know, structure of the transaction, earnouts, all those sorts of things that, you know, and obviously strong target company fundamentals that investors are willing to say, hey, I'm in this at a $10 common equity pipe or whatever it looks like. And I view there being a pipe as long as there's not, even if it's at a slight discount. You know, you look at like Live Oak 5 and Team Shares, it's a $9.20 share price on the pipe, but it's purely common equity. You know, that's a great pipe to me still, as long as there's no bells and whistles like founder shares, warrants, all that other kind of stuff. So, yeah, we are seeing largely the same parties we saw 5 years ago. You know, the market ebbs and flows, and I think they're already back. A lot of those guys are back, ready to take risk again.
Yeah, again, agree everything that Joe just said. You know, in addition, the D-SPAC are trading better. Like back in 22, a lot of them, like we pointed out, getting bad deals done because sponsors were desperate, overvalued targets. They all traded down to $1 or less. Now we're seeing average of $5 or higher. So the pipe terms have gotten better. These have traded better post D-SPAC. So, like Joe said, we're seeing common equity pipes. Maybe it's a discount to the $10, but it's clean, no structured deals. Some are structured where they're not sure what the valuation should be because there's no real comp. You really don't know how to value it. And then there may be like a price reset, but we're not seeing 5 price resets every 3 months where it just goes down to 0. So I think it's a byproduct of better sponsors, doing better deals, better targets going public, and less desperate sponsors just chasing, you know, very early stage companies.
Yeah, it certainly seems like when you look at the announced transactions and how they're trading, warrant prices, trading above trust, et cetera, there's certainly an audience for deals that have been brought by sponsors that did their homework assignment. I think, if you go back 2 years, they did all of that, you might still not have found an audience, right? So it does seem like some of the trust that is required for this process has been slowly rebuilt with investors. They're willing to come back and look at it. And obviously, it only takes a couple good transactions before people, forgive all the past results. I guess my next question is sort of, how important do you think pipes are to the de-SPAC process? Are they the best tool? Are there other tools that might make more sense? I think that's a good one for everyone to sort of chime in on.
I think they're still incredibly important to the de-SPAC process. Look, companies are not going public just to be public, right? They are going public to try to raise money, to be able to raise money in the future. And this is sort of an element of their, seeing what the market for them is. So I think it helps on valuation. I will be interested to see with the new proposed rules from the SEC, whether with, allowing de-SPAC companies to use Form S-3, whether that will reduce the reliance on pipes and create more of a situation where companies are willing to go public, be able to use S-3 immediately and raise money that way.
Yeah, I agree with what you said there. I think they are critical. I think it really validates the transaction. You've got institutional validation that the price is right. It's a company that should be public, so on and so forth, and that matters. And I actually think that high quality pipes are actually going to help reduce redemptions to some extent as well, because investors who don't have access to the pipe for XYZ reason have the ability to buy shares in the open market and retain that, roll them through the transaction and keep it in trust. So I think higher quality transactions result in high quality pipes, which result in fewer redemptions.
Yeah, I agree entirely. I think that pipes are a strong mechanism. I think that in terms of seeing these de-SPAC transactions happen, I know that we've seen some amount of strength in terms of lower redemption rates recently, but until we actually have those become the norm and not the exception, these targets are not going through this process to raise money in the future. They're raising capital now, and they want cash to the balance sheet, and pipes are a great way to do that. It's attractive for all of the parties. It's a rationalization of the valuation, and it guarantees some level of cash to the balance sheet post de-SPAC.
Yeah, I mean, part of the issue was we saw a lot of deals, over the last few years where there was no pipe. They then had 100% redemptions, and they're stuck,
yeah.
right?
It's also, as you said, right? You don't have that independent third party validating the valuation, right? It's really important for that as well.
Yeah.
Well, and it sort of goes back to the earnout thing too, right? If you don't have capital to light the fuse, it's never going to happen, or it's going to get so shifted out that you're 2-3 years into it, and your growth is just lagging behind. So, you need the capital.
Yeah. And in a lot of cases, you need PIPE to even close a deal because you need to show NASDAQ that you've got a year of cash flow or burn available. So in some cases, you can't even close it unless you have that. And otherwise, they just go public and then they get desperate and then do toxic deals and then get delisted. So I think the goal is to avoid a lot of that, and that's the steps I think a lot of NASDAQ's taking that, exchanges are taking it. So I think PIPE almost becomes important.
Okay. I'm going to just take the opposite view for argument's sake, just to keep it interesting. And I guess not highly popular as an opinion for underwriters to have, but I think if you look at the history of the SPAC prior to the bubble, you'll see that PIPEs were the exception and not the norm. And the reason for that is that the SPAC worked by having a protracted multi-month marketing process where it built investor interest very broadly, unlike an IPO process where it sort of went to the top 50 accounts for large investment banks. It was a democratic process. Anybody could participate effectively. And what had ended up happening was that the original sort of yield-oriented investors, every 25 cents that the stock went up, they would sell more of their position, and the shares would recycle, right? And the benefit of that is because we're all talking about PIPEs being a validation to value, right? And in fact, if the shares are trading above trust, meaningfully above trust, you know that those investors aren't buying the shares just to redeem them for $10 later. So that was really the way that you built validation, you built following to a transaction, and obviously you also knew that you would retain capital, right? So when, for instance, you saw Boost Run announced, it was trading at 1060. On a sort of initial print, then trading better than that, like it was pretty obvious that it was unlikely to lose significant capital to redemptions. When you do a PIPE to replace that capital, you're facing a couple of headwinds. The first is that you are taking the fundamental interest in the business, you're diverting it from the public markets into the PIPE vehicle, which means you don't see the recycling process. The market doesn't see the recycling process. It doesn't see the deal validation. And then, when you mention it to a new investor, they say, well, they pull up on their Bloomberg, there's no volume and it's trading at $10. It's like, I don't know if it's going to go down to 3 or if it's actually worth $10, right? There's no informational content in what the tape is telling me. The other issue is that oftentimes, because you are committing, to a less liquid security earlier on, you're naturally going to want to get a discount. And if there's a discount, and I understand a small discount, but if the discount becomes significant and becomes a fix for a valuation that's too high, then it's a self-fulfilling prophecy that you're getting 100% redemptions, because if somebody could buy it at 8 and you're being asked to stay in on a trust at 10, you're guaranteed to lose money because that stock will trade asymptotically to the lowest effective price until, it gains its footing after the technicals have run their course. The other thought that I would leave you with is, again, if you have a target that cares about this as a business that they're committed to, that they're looking to grow, they're not looking to exit, they don't want to do private equity, all that stuff, ownership makes a difference, that post-money ownership stake. And so if you raise a $100 million PIPE and then you have a $100 million trust, the danger is that you also retain the $100 million in trust, and then all of a sudden I might have $200 million of dilution or only $100 million. So my ownership stake could be dramatically different, and that might not appeal to certain targets. So traditionally the way PIPEs were used was really to augment capital if the trust was too small, but the deal was validated. So basically you get the answer at a different part in the process, which is to say, on the shareholder vote, and clearly you can, if you want to be intellectually honest and hold yourself to a high standard, you can include minimum cash conditions so that some of the outcomes where, you have a dilutive raise, the target is disappointed, they can't fund their business plan, all that stuff, you can avoid that by making sure that you have a minimum cash condition and you don't waive it at the last minute.
Yeah, so I just in responding to that, right, I totally agree with sort of the historical analysis, but I think the problem that what pipes do, right? They fix that a fundamental problem, right? Because targets don't know how much money there's going to be available at the end of the day, so they want some certainty. And SPAC sponsors don't want the ability for a target to opt out of the deal at the last minute because there isn't enough money. So they solve that inherent problem in the structure.
And just to add, I mean, PIPE's going to be unregistered, so they are taking that registration risk, which SPAC IPO investors not. They're getting registered shares at $10 day one, versus a PIPE investor that could wait 30 days, 45. I mean, we've had situations where the PIPEs never got registered, so there's that added risk to it, which is why they ask for the discount or other structures to it.
Yeah, no, I mean, absolutely. And I'm not to say that, it doesn't make sense in any circumstance, but there is another way of doing this if, the exact quantum of capital is less of an issue for the target, and it's more about being public and having the ability to access capital markets ad hoc. But, what about some other structures? What do you see as innovations in this cycle versus the prior? Like, what have we learned? How have we adapted? Where's the innovation?
I mean, we're seeing more non-redemption agreements, which is basically another way to validate the valuation. Okay, your business should not be, $10, it should be $8 or $7, and you go back to the same IPO investors, and they own shares, so they will not redeem at a certain valuation where they think it's fairly valued. So it's not a new innovation; it's just another way to get a clean common equity pipe. The other stuff we're seeing are the usual, pipes with price resets. Once the resale goes effective. I mean, those are still pretty common ones we're seeing. I don't know, Joe, what you guys are seeing, but those have been the usual bits we've got on pipes.
Yeah, I would agree with that. Honestly, I don't really have much different to add, but that's sounding repetitive. So
Yeah.
Good. So, one of the things that's interesting about this SPAC cycle, I think, is the very wide range of terms that sponsor teams are going out with in terms of IPOs. Curious to get your take on what that means for the de-SPAC process and sort of the target side of things when there's structures all over the place. I think targets had a hard time wrapping their mind around just the standard SPAC, right? So what are you seeing there?
I think that respectfully, people are smarter than they were 5 years ago through this process. If you have to go with heavy structure on your SPAC, and there's obviously a little bit of pain as a first-time sponsor because you don't have the repeat, credibility with the market. But if you're having to go out with heavy structure on your SPAC, there's a reason why. And the market's basically saying, if you want us to lend you our money for the cash and trust, you have to pay us more to do that. And it probably means that you shouldn't raise a SPAC at that point in time. I'd say this negatively, as a banker, it means we're not getting fees. But reality is, if you have heavy structure, the likelihood of 100% redemptions skyrockets. And you're paying to rent capital. And even to do a pipe, it becomes more challenging because you've got rights, warrants, all these crazy bells and whistles that are dilutive to the transaction that's going to just reset the price that much further. So I think as a target, it's something you have to be very mindful of. I mean, a sponsor should be a sponsor in the sense of the word. They should be adding some value, right? Not just providing a vehicle for you to go public. Mm-hmm. And if that value is extremely dilutive value, and they're not able to bring a pipe to the table, i.e., backstopping their own, pipe with a lead check, or providing some type of strategic value because they know your industry and whatever the case may be, I would tell you go find a SPAC with less structure. Again, not trying to be rude or disrespectful. It's the reality. It's a math equation at the end of the day.
Yeah, I think you're right. I think targets and advisors are a lot smarter than they used to be. And if they see a SPAC with a lot of dilution, a lot of structure, they're going to advise their clients, maybe this is not the best best opportunity for you, or try to get some concessions from them, and it makes the negotiation more complicated. So yeah, I'm with you on that.
I think you can run a pretty simple math equation. Like if you see a SPAC with, say, warrants and rights, and you can figure out pretty easily what the implied share price is going to be post business combination closing. And I can tell you right now, the math doesn't equal $10.
And I think that, what we've heard throughout this conference is the market being increasingly focused on target readiness. This is just flipping that script onto the sponsors. Like, if you're not ready to be a sponsor, you're going to have these heavily structured terms, and that's what the market's going to make you bear, right?
Yeah, I also think too there's like an element, like the buyers of SPAC IPOs don't have the same size of books that they did 5 years ago. Leverage is more expensive, et cetera, et cetera. So for them to go and sell one position and make room for another position, they're going to be asking for more. So there's inherently like kind of a capacity in the SPAC market, so to speak. And, it feels like we're kind of there right now. But, we continue to see deals price pretty regularly, so.
Yeah, and just to add to that, I think there is a lot of SPACs chasing capital. I think I saw some stats, 42 billion or something is chasing, private issuers to merge with. If that's the imbalance, you're going to see, like Joe was saying, any investor to put up money for another SPAC requires them to take it away from something else. So I think that imbalance will start changing when there's more de-SPACs that close, more capital frees up for these investors. The risk capital deals that were done like last year or the year before, those have not closed, so their money is still tied up. So as that happens, you'll see the terms, again, get better, but right now there's definitely more supply than the number of de-SPACs closed.
Yeah, and look, I think one of the things that I've learned is it's very hard to handicap a priori the success, probability of success of a sponsor team. There's been a lot of highly credentialed guys who decide, this is too much work. I called 5 of my friends, they don't have anything. I don't care about my $5 million in risk capital, and they kind of go back to their lives. And then on the other hand, you've got some, scrappy guys whose $1 million investment is everything for them, who are fighting tooth and nail to get something done, and they'll surprise you. They'll be a sleeper hit, right? So I think there should be a way to, pay whatever table stakes and, go through the growing pains of that first one and establish yourself. It's democratic to let people have that opportunity, right? But they should go in understanding that, these are issues, and maybe they should, pick targets that make sense with the structure, and can still work with the structure so that they can succeed and come back with, better terms the next time around. Well, I think I'm winding down on questions. I don't know if you guys have any, final thoughts that you'd like to share with the group, or if we should dismiss everyone a bit early.
We got a question out there, actually.
Question, please.
How common, or what are your opinions about that target setting a minimum cash net proceeds to de-SPAC?
So yeah, I guess the question is, how common is it to set a minimum cash balance? I think it's pretty common. It doesn't have to be a crazy number. I think a realistic number of 10 million, maybe net of expenses, is a reasonable number. And if the sponsor or the pipe market doesn't support that, it's telling, right? Maybe you shouldn't go public. Maybe you're too early stage.
Yeah, I think there are a couple considerations, right? First of all, as Gaurav mentioned, it's sort of like after costs, right? So, the exercise should be accretive on a cash basis, right? You shouldn't be losing money to go public in that way. I think the other consideration is, what does your business plan require for the next 18 to 24 months, right? Because if you're going to investors and saying, you're going to have all these growth opportunities, but they require capital, and my valuation is based on those out-year, goals, then investors know as soon as you fail to raise that money, you will miss those goals and the stock will trade down, right? So it's really this balancing act of coming up with a actionable, realistic plan that requires capital, but then holding yourself to having that capital available.
I also think there's an element too of, you go too big to your kind of follow up there, putting a big number on it. Most investors don't write, multi-$100 million checks into a pipe. So if I'm a fund investor and I typically write $20 million, $25 million pipe checks, and you've got a $400 million minimum cash condition, I'm like, well, my 25 doesn't move the needle. So, I'll hold off until you have much more of it committed to. So you're kind of creating this effect of until you can go and find large amounts of capital, but it's hard to find those first checks. Those lead checks are the most important on a pipe. But if you can't find a lead check that's probably 25% of your pipe, maybe larger, I think it's a tall task.
Yeah.
And by the way, I think that's where sponsor relationships and target relationships make a difference, right? Because that initial check is probably a relationship or a strategic that can benefit from this company being public and wants to support that effort. And to your point, like the average hedge fund out there doesn't want to be the first investor. So yeah.
I also think this is when there's when you're trying to raise a large amount of money in connection with your DSPAC, it's more important for there to be a pipe set at the time that the BCA is announced, because if you're announcing your transaction before with a large minimum cash without any commitment, you're almost guaranteeing that people are not going to be willing to come in, right? That's when it becomes more important, in my mind, to have a pipe set ahead of time.
And just to add, most issuers, sure, they need capital, but they don't need all that on day one. So let's say your need is 100 million, maybe the first tranche is 20 million, and the overall facility is 100 million. You spend, register the securities, it all works out well, share price is trading well. They have no issues redeploying another 25. So you can get to that 100, 200, but no investor want to just deploy all that at one point. They want to see the issuer deliver on the milestones that they promised, and the investors see the stock price appreciate. There's no shortage of capital. They just want to make sure they test the waters, see if the management team delivers to redeploy additional capital.
And of course, that's good for the target also, because as the stock price goes up, the equity cost of capital is going down, right? So you're raising capital at more attractive rates to you, and that's the whole point of being public, is to have that access to capital over time.
Yep.
Anyone else with questions? All right, well, I want to thank the panel. Go ahead.
Mark, can I just make a quick announcement on our golf simulator winners?
Please.
All right. One thing I found out today is CFGI plays a lot of golf. I think they were the top 5. So the winner of closest to the pin was Chris Brandis of CFGI, 2 feet 2 inches. And the Amazon card winner for the raffle was Russell Deutsch of White and Case. So Russell, if you're still here, please try to find me, or we'll mail it to you. I doubt he's here, but I hope everybody got to enjoy it. They said it was a big hit. So thanks for coming out.
Excellent. Well, thanks, everyone. Pleasure to see you on the panel, and thanks for your insights.